Our third speaker has probably worked on the other side of that picture in a sense that he's certainly been very heavily involved in putting together proposals and putting together funds for agriculture to seek investment from, particularly, and in some cases, the superannuation sector, and that's Frank Delahunty, who's known to many of you. Frank's background includes farming, being a company director and business advisor. He's been a manager and co-founder of Australian Farms Fund Management Proprietary Limited, and a trustee and custodian and manager of the Sustainable Agriculture Fund, and it was having had similar roles in dirt management and the Warrakirri Agricultural Trust. He started his career as an accountant and a partner, and has been involved in auditing and consulting as well. So I guess there's probably no one better to tell us about the realities of working with superannuation fund investors and putting them into agriculture than Frank. So please welcome Frank Delahunty.
Thanks everyone. I'll have to go for assistance with my eyes, but the problem with being on the second day is a lot of people have taken a lot of your thoughts and concepts and principles. But just to cut back to it, we've spun around to China, we've been into the offices of IFS, but we're back to the farm with me. So the investor perceptions, basically, might give me a fairly open brief just to tell it how it is. So I'm just going to talk about my story of about 20 years trying to raise, manage money out of the superannuation industry only. Did not go overseas. We funded all this out of our pockets. We didn't have any big badges behind us, so it was our own passion, commitment and interest to try and get an alternative form of capital back into the regional areas. So my comments and my perceptions of roughly 3 times trying to raise money. 92 to 96, dirt Warrakirri. We were raising money, got going in 96, 2006 to 2009, the Sustainable Ag Fund, and then in 11, 12, Sustainable Ag Fund, after we invested our capital, we were looking for it again, and my old ticket give out. I just had enough of the levels of bureaucracy and process, and I thought, nah, get out of this, let someone else in the bit younger have a go. So I had a bit of health issues. I thought, no, I'll go back to somewhere I enjoy a bit more. Where do we point? Just click it. Where do I click? Righto, just a bit of background. In the Wimmera, Victoria, did accountancy, saw the implementation of the SGC. So 13 years from 93 to 2006, marketing and raising the concept that well-managed agriculture is an alternative asset class for superannuation funds. I have to emphasise the well-managed, and we use the ABN Top 25 as an example. I use the word rain-fed. The perceptions in agriculture are horrible. When we talk about dryland agriculture, minds people go to drought. So about 5, 6, 10 years ago we started to talk about rain-fed. It's not drought rain, it's just rain-fed cropping. And sure, it's variable, but it's not dry land. It's rain-fed cropping, and I'd love to start changing terminologies, and that's just one of them. So we raised $60 million in 96, and when I got part of it was 84. So most of my conversations are going to be focusing on the period of the dirt Warrakirri. Dirt was the management company for the Warrakirri Trust. When I stepped away from that to go and set up the Sustainable Fund, Dirt was extinguished and the administrative and management functions were brought inside the Warrakirri Trust. So stupidly went off and chased money again under my own volition with support of other people. So again, looking to raise money. So in 2009, so through the 2008 GFC, it was a tough time to raise money. Repeating, didn't go overseas, didn't buy any overseas tickets, was always around Australia. Walking up and down the streets of Sydney and Melbourne with bags in your bag, felt like a prostitute yourself, trying to raise money. But we finally got there in 2009, raised 145, 7 Australian institutions and a high net worth. So this fund was a diversified cropping, livestock and dairy. 2012, as I said, stepped away, but again and proudly, the balance sheet when I walked away was higher than what I started with, so it was 151 million. And that's after acquisition costs. So one of my little perceptions, and I went to Churchill Fellowship in '97 to study institutional investment agriculture, and I learned a lot from it, and I'll touch on a few of those points as we go through. But one of my little beefs is I just struggle with the fact that the pleasure of buying a farmland will cost you 5.5%. If you want to go and buy an equity portfolio, it'll be less than 1%. So I just think it's a discriminator that will never change. But the old taxing systems we used where wealth was tied up in property, so we levied stamp duties. Now most of our assets are tied up in the share market and you can micro trade in 30 seconds, and I don't know what you pay me to do that. But in our case, as an asset class, we bear a burden of revenues via the stamp duties that other asset classes don't. And I think the perceptions Rick's asked me to talk about, that's one of the difficulties we've got, because you just take 5% out of your balance sheet the day you write out the cheque to buy the farm. I'm in Churchill, I travelled, and it was interesting, someone said yesterday that some of the funds overseas have been doing invested ag for 6 years. From my experience when I went over in '97, that in the 80s, a lot of the current fund managers in America started to invest in agriculture. That was through the American debt crisis, where a lot of the life insurance companies were by default. All of a sudden they had defaulting farmers on their hands, and so they started off they call it the 5-3, 3% net return and 5% capital gain. I mean 5-3 the other way, figure versa. So a lot of the fund managers started in the 1980s by default. Now that's spawned my own knowledge, and I met all the major fund managers overseas. A lot of those spawned out of that default crisis, and then in 1991 they started the Nuclear Farmland Index, and Michael Blakeney and David Sackett talked about it yesterday. Back in '97 I learned that I think until we as an industry have a reputable index where it provides a bridge to the institutions about credible, timely numbers, I think we're going to struggle to talk to these people up in these offices who are looking at numbers all the time. So what happened in the US was the ag managers got together for common value and common use in 1991. So the US Nuclear Farmland Index, and if you don't know about it, just hit the web. It's got figures since 1991 every quarter in a methodical, timely manner that all other sectors that we're trying to compete with provide. So we've been running around, Michael Blake, as I said, David Sackett's given us support. We've got people who are supporting us, but some of our leading ag managers in Australia talk about ag and not supporting it. So it just, perceptions are, if we want to go to the big league, we've got to make sure we provide the big league with the things they want. And data, and credible and timely data is one of them. We've been using ABARE. I use ABARE for the top 25% for the last 20 years, and the top 25 and all that sort of stuff. But to be blunt about it, it comes out in March, 18 months after the financial year's ended. It's just not timely. And then yesterday, they're not here today, but yesterday the productivity report was dated 2007. I'm thinking, if you're going to talk to the people who are making decisions, they go, we've got these 2007 figures for you. So, perception, ag's risky. Ag, just repeating the threshold, I won't go with that. Top 25, is it risky? When all the analysis we did, ag has lost money using ABARE data only twice in the last 33 years. Whereas, I understand the equity market, we touched on every 6 or 7 years you're going to get a negative number. So, again, we don't put these numbers up too often, but now I'm far enough away from the period that I was matching that. So there's my numbers over the 10 years from 2006 to 96 to 2006. So when David put up numbers yesterday, some of the poor performance, until we can get numbers with track records that people look at, we're again going to have trouble. 5 to 6% income, remembering this is through the 10-year drought. The split was around nearly half and half income and capital. You'll see there, and I disclose this, I might have trouble, but there was a mismatch in my mind, and David touched on it yesterday, between the fees that we got, and I was a beneficiary of those fees, but the fees that we got and the investor reward. You can see a quite large gap, and I morally, ethically didn't feel comfortable with it, and it's one of the reasons why I stepped away. We've got to have a good balance, and that's a total fee, as I'll try to disguise a bit, but you've got to have a balance between the investors are taking the risk and the manager who's talking about it. So I think a lot of the structure we've got going now, I used to get really grumpy at MISs as a bad portraying of the investment community into agriculture. But I must admit, I'm hearing more stories about other people in the sector who are taking fees of 10s and 20% up front. No business can take that and ag with the small margins and turnover can't afford it as well. So again, my perception is until we get reasonable, touching on David's comment, until we get reasonable balance between the investors' reward and return and the managers, I think we're going to be in trouble. There's a risk, I say 82% is in land, it's not going to blow away. The other 10% is in plant and equipment, that's still in the shed if it's a poorer year. So generally we used to put a risk of 8 to 10% of our working capital each year. And to be blunt about it, in 1 year we lost 1%. We had a diversified spread in the dirt Warrakiri from Queensland, New South Wales and Victoria. So right in the raging drought of 2006 we went negative by 1% operating. So I just think there's always an imbalance when people say drought and they show a shot of a farmland with dust blowing over it. It just doesn't happen in perception. I think it was 4 or 5 paddocks we didn't put a header in during a poor year. So it's not a drought, it's just a poor rainfall year. So when I was going into the investment committees, the boardrooms and all these other people that you go through, and Sacha listed down those quite well, the icebreaker was typically, you go into these places, they say, how's things in the bush? I hear it's tough. Now I reckon 80% of the time, that was how we started the conversation. So I said, we footy team won yesterday, it was a really good day in the weekend. It just had to get off their perceptions about ag. So I used to say, well, it's funny, I've seen leading farmers buying Toyota Land Cruisers, Saharas, they're buying new farming equipment, travelling overseas, and renovating the kitchen for the missus. I don't see that as being tough. So we've got to know who we're talking about. We're going to talk about the squeaky wheels or the people who are making it. There's been lots of charts and stuff, and I want to put a little shot up. This is what real assets are about. This is real ag, it's a real farmland, and it produces real stuff. So this is an example. This is one of our staff farms in New South Wales. It's an example where the vendor was 72, the kids didn't want to come home because everyone's saying, no, come home, it's tough in the bush. The guy who was the senior manager on there, we appointed as the farm manager, it's still going on 5 or 6 years later. That's a irrigated property, land and water, long-term, both of them will appreciate. Is equities risky? This has been touched on already, but I do a little bit more simple than dot charts and all that sort of stuff, Sacha. But I'm just really intrigued that I think we've had a love affair with the equity market. And you look at these numbers, and this is the APRA figure, so you can just look up, you get a one-page summary of our $1.8 trillion worth of money invested. And I don't think you need to be rocket science to work out what the trends are. I think the equity market is a risky environment as well. And we were trying to emphasise that point to our super fund people. At the end of the day, 82% of the money invested for you is in land. But thank God we've had a 16.7 kick. This is all APRA stuff. You have the data. Default funds. But I reckon there's a trend going down. So I'm still amused by this this perception of ag being risky when most of your money's tied up in land in our case. I think we're in a world financial stage that ash clouds, terrorism, Greek events all affect the equity markets. So I struggle with the fact that at the end of the day, something like, as I said, there's more than 50% of our superannuation funds under trustee assessments are to be in equities, world and Australia. And so the difficult, as Ash was saying, we've got a declining opportunity in unlisted space. Well, I sit back and say, why do we have general defaults in these industry and super funds in Australia? We've got over 50-55% tied up in equities. Roll at about 10% to 40%, put the other 10% to unlisteds. That's just, I'm supposed to ask questions later. So the super funds generally are targeting, if you go to a lot of their websites, they'll target 2 to 3% above inflation, which is around 6 or 7. So to be truthful, when we second round and trying to get the sustainable ag fund going, we were often said, oh, it's got to be over 10, we prefer 13% return. And I used to, like the economics when I did my accounting degree, one of the lessons was higher return, higher the risk. So we had that mantra and we're trying to raise money that we've got to be well over 10%. So hearing the stories from David this morning that people are running around looking for 5, it's going to be tough work, guys, to continue to raise. That's just already touched on a bit of this stuff, so I'll move it out. But The number of times we went into meetings, this started back in 92 and 96, we went in meetings and we talked with asset consultants and investment committees, and they just endlessly argued about what box we should go in. I hear you say private equity, and I hear private equities are only 20% in next 3 years, so I don't feel that's our box. I think we're property. We've got a lot about correlations and aspects of property, but we've got an overlay of investment risk by the operation side. But all our correlations, if you look at all the long-term land values and look at long-term commercial and industrial properties, we've got a very similar correlation. But because we seem to operate the farm, we're perceived as the private equity, and so we get try to be shoved in the 20 to 25% basket. It just won't fit. In 92, there was no expertise of ag. When we started walking around in 92, 96, and one of the questions that's actually I'd like to ask is, people know asset consultants? Everyone know what we're talking about? Put your hand up if you know asset consultants, please. That's what they do. Well, we've got a problem. Well, they are the gatekeepers. Now we go to sheep. If you go back to the farm, and I grew up as the old man was up at the front gate with the sheep coming through, and you got the good ones and the culls. So asset consultants, the gatekeepers, you happy with that? And if you can't get past the gatekeepers, you won't get there. Right? So they've got everyone with a great idea rolling up to them, and the super funds say, go and talk to our, I use the analogy in the farming scene, go and talk to your accountant or your lawyer about accounting and law matters. When super funds talk about your great idea about investment, go and talk to the asset consultant, they're the gatekeepers. Now be blunt about it. 92, 96 were raising, 6 and 9 were raising, not one of the asset consultants had expertise and specialisation. Has that changed? Not much. Got an answer I wanted. So, right, so the problem we've got, the people who make the decisions to do the analysis of agriculture, asset consultants have not got resources they've applied. They've got millions of analysts doing mining, millions of analysts doing retail, property, etc. They haven't got any expertise in-house to make very influential decisions to the trustees and investment committees about ag, and they've got no expertise in there. So if we as an industry want to try and get something done, we've got to get the asset consultants to invest in assets, skills and levels. So I go to the Warrnambool cheese and butter, everyone knows about it and talked about it, but did anyone hear any of the asset consultants of Australia representing superannuation funds doing any due diligence? I don't know, but I don't believe so. Liquidity, we touched on that, the 1.8 trillion. Sasha's done that. My commentary is that, if 1% of 800 million goes missing, that means 99% is a lot of money. So I think there is a massive amount of money that goes in industry superannuation funds. I assume you've projected the 9.2 up to 12, what that's going to be, but I think we're discriminated against because we're not a liquid asset. I'm saying that the average age of people is 30. It's going to move out to 70. There's 40 years for the long-term benefits, and I respect the numbers you put up there, Sacha, but it is a very liquid industry, the industry super fund, because not many around the world have got this legislation to put money in each month. So is superannuation patient capital when agriculture is a very good fundamentals, but expensive to enter yearly production and not monthly cycles? I think a lot of the trustees of super funds react to all those reports, how your fund went last week and last month. It's a bit like politicians in the survey poll. They're all jumping around Malcolm Turnbull now over Abbott because the survey polls aren't looking good. My attitude to agriculture is a long-term with results that are around 12-month cropping and breeding cycles. Weather patterns that can go for 10 years. We can have a 10-year lower rainfall period. So patience to me is to go at least 10 or 15 years and beyond in a long cycle. And to be blunt, most of the people I dealt with, we got built up pretty heavily when we were just getting started, pay our 5% stamp duty at the front, get our rotations and cropping systems into our farms, and you just, it's not like painting the office block and all of a sudden you've got a new tenant in there. It takes a long while to get your proper, good, sustainable farming practices through. We're unsafe. Whoops. We're unsafe industry. Everyone says how safe and what a dangerous industry is. So is the transport and building industry, but again, investment continues in those areas. But on further investigation, nearly 50% of accidents are under 15s and over 65s. We can employ those people. So professional management, we kept our records, so we had lost time of 0.06 over 73,000 hours That's a pretty good record. But you can't get that out because everyone says, oh, it's unsafe for industry to go in. So I had a go at the asset consultants. If we're going to get anywhere, we've got to see asset consultants are going to put a resource analysis on the agriculture specifically. Fee structures will be fairly balanced between investors and the managers. In our case in SAF, we had our performance fee based on income. Because my theory is land values will go up roughly by the market. What have you done to do the market? How will you as a manager, if you go to the top 25, you produce better income? And then I push away at the ag index. We're quietly trying to get that done, but unless we don't get support for that, the bridge between us and credible numbers to the institutions won't be there. And balanced commentary. I think someone knocked that photo off, Graham knocked the canola photo off yesterday, but it's a great sight to see the golden canola in springtime. Thank you.